Hello, this is Rich Canlione coming to you from CME Group Trading Floor. Today's segment is buy the rumor or sell the pack. The pack, of course, the crowd, all still getting on board and most adjusting their asset mix models to reflect more risk, more equity exposure. Problems are, not all is gone in the U.S. That is, we still have problems with the budget, we still have problems with the potential sequestering, so we still have some issues there at hand, and Europe, of course, there's still some issues there that are not yet resolved. But price is price, and we all know that portfolio managers at this point will be chasing performance and essentially forced to buy in. The only issues at hand are that when you look at some of the technicals, the dailies as an example, are added on the cash, the SPX are overbought in terms of the 2 standard deviation. That comes in roughly just through the 1458, 59 level. The normality or mean reversion on that would actually be SPX at 1423. Interestingly enough, not unlikely that considering the amount of move that we've made from, if you take a look at it on the graph, we've essentially gone from 1383 in a very short period of time. We're talking about in the last 4 days, and mind you, not a very large increase in open interest, both in the minis and in the pit volume as well, which suggests that a lot of this might very well have been motivated where you had some shorts on in light of the approach of the fiscal cliff. At any rate, looking at some more of the moving averages, if we take a look at where mean reversion would be, we would be looking at essentially in the SPX at 1423. That 5.5% move, if you took 50% of that in terms of in the futures, you'd be looking at essentially the 1420 area. Interestingly enough, the 100-day moving average on a retracement would be the 1422 level. If you take a look at the interest rate scenario, obviously the benchmark being the 30-year, we have gone in that short period of time essentially from 276 yield to the highest yield that we've seen since April of 2012, which is 315. Now, obviously, a big fuel in the equation in terms of the economic recovery has been refi money. You've had the consumer refining and having a little bit more of disposable income to be put to work. If refis now get a little bit more expensive, you have less discretional income to be put to work. That also is suggestive of conventional wisdom where the consumer might be a little bit tight-fisted on that. Again, looking at the 100-day moving average, a lot of times when we make a big blowout move like that, we come back and revalidate that. So at this point, I think rather than buy into the move, obviously we want to participate because all the economic releases that we've seen have been much better, especially the non-farm payroll number that we saw this morning. So rather than just jump in, the best thing to do is perhaps play it a little bit more cautiously, look to buy it on pullbacks. But at this point in time, I think what we might want to do is actually look to buy some cheap puts because I feel that we should have a retracement coming. As an example, the January futures 1420 puts are trading just at $3, and the 1415 puts are trading under $3. I think that those would be a good buy considering if we do have a little bit of a pullback after the whole January effect is out of the way and the market is done with this move, we should pull back perhaps to mean reversion, perhaps the 100-day moving average. Play the moving averages smartly. This is Rich Canlione from CME Group Trading Floor signing off. Thank you.